Joining us is DoubleLine Capital Deputy CIO Jeffrey Sherman and Crescent Capital founding partner and CIO Jack Ablin. Guys, welcome. Jack, you from here, now that we've got the CPI print, we've got the commentary from the Fed, you say that earnings are important. So tell me about bank earnings, particularly regional banks. What are the most important signals to watch from here?
Right. So, of course, it's deposit gathering. Are they able to gather deposits? Because if they're not, they're going to have to reduce their loan book. We're seeing over the last 2 weeks, for example, commercial real estate loans among small and regional banks down by $30 billion. So what we're watching is not only the banks, we're watching the blowback on credit. So, kind of a couple of pieces at play here.
Okay. And Jeffrey, you have said the bond market got to negative in January. Now we've had a rate hike. Looks like the Fed isn't ruling out another one and a recession. So what should investors sell or buy here based on how the environment has shifted?
Well, I think what's really shifted now is we've been exposed to this banking crisis that we had back in March. And, as Warren Buffett was saying this morning, that, we're not really out of the woods yet. And so I think what you really need to think about when it comes to your fixed income portfolio is the quality of the credit that you own here. And so we've upgraded our quality of our credit, migrating up the spectrum in terms of rating over the last, 9 to 12 months. And I think that's still prudent to do today. And I just heard the last segment of the last show, too. They're talking about, where the equity market is today. And some of the credit markets are in the same position. You have high yield kind of at the lower end of the spread range as well. And so to us, it's not the time to be adding to riskier positions. It's the time to be a little bit more defensive. And part of that defensive positioning includes owning things like treasuries and government guaranteed debt at this juncture, because really, a lot of the risk markets aren't really pricing in the semblance of a recession. So you have this problem that the Fed is likely to hike in 3 weeks' time, but no one knows the path subsequent to that. There's a lot of data that has to come through. And I want to remind all of your viewers today that the data that we're looking at right now does not really include the fallout of what we've seen from this banking sector today.
Yeah, it's a key point, Jeffrey. I mean, Treasury yields were kind of all over the place in general today. I mean, they dropped like a rock after CPI. You had that soft 10-year auction. You had the minutes that investors are digesting as well. But then you also had the Bank of Canada holding rates steady. You had very dovish commentary talking about the need to continue to be stimulative out of the new head of the Bank of Japan as well. How are all of these different cross currents affecting what we are seeing in the bond market right now?
Yeah, well, some of it's coming through the currency markets as well. As we've seen the dollar really trade near the low of its ranges as well once again. And some of that's the repricing in general of the U.S. and thinking about maybe that the Fed is kind of done with the hiking regime after the hike that they're likely to deliver in 3 weeks' time. But you also have the other side of the equation, too, where there's talk of the ECB being more hawkish and having to deliver on the other side. So I think that's really what's hitting some of these markets today. But the rates market has really sniffed out the end of this, or the peak in the inflation regime that we've been under from last year. And we saw that really in the peak in rates back in, let's call it early October of last year. And since then, now we're starting to think about the slowdown. And I think that's really what the rates market is showing you today. But there's been a lot of short positioning in the marketplace because, again, the Fed is going to deliver on these rate hikes. But also you have this neuroses in the market that we also have stress in the system. So it's going both ways. The bond market has been volatile for the last, let's call it 15 months or so. And unfortunately, it's probably not going to die down until we get more clarity on what this data looks like.
Yeah. Jack, when you do have the Fed in their minutes today talking about a mild recession, are equity markets priced too high right now? And I ask that. They're talking about this in the end of the last hour, too, but I mean, the bursting of the tech bubble back in the early aughts, that, too, was a mild recession. But, man, was it painful for stocks.
Well, it was mild.
Jack.
It was, but equities were certainly way overvalued. I think we had price to sales ratio at a rate in 2000 that we had never seen before. So I don't think that the valuations are quite as extended as they are now. I do think that, this is probably one of the most widely anticipated recessions on record. Yes, okay, earnings, this quarter or the last reported quarter down 6.8%, something like that. Normally, a recession corresponds to 20 to 30% decline in earnings, but we will get an offset in the lower rates. We think that rates will likely in the 10-year be substantially lower. We run a copper gold study that's been very predictive of the direction of 10-year, and it's suggesting that the 10-year rate should be a fair amount lower. So I do think what we may lose in earnings growth, we could pick up in a wider multiple because of the lower PE.
Okay.
But following up on what Jeff said, I agree. I mean, for us, it's quality across bonds and stocks. And we agree that we think that the high yield bond market is just really vulnerable now when you compare it to how the banks are tightening their lending standards. The bond investors are not.
Jeffrey, to follow up on something else that you said, about government-backed debt in particular. How should people, particularly in higher tax brackets, think about municipal bonds here?
Yeah, well, municipals have been something where there's been a clamoring for that because of the tax policy out there. And municipal bonds actually do look a fair amount rich relative to treasuries today. And so on a tax equivalent basis, ultimately, actually, the treasury market does offer a fair amount of a better value, especially when you adjust for the credit quality today. So I know a lot of people look at the muni market for the reason that they don't want to go through the cumbersome nature as we approach tax day here of having to fill out all the tax forms for those investments. But ultimately, right now, I think the treasury market does offer better value than high-quality munis today.
Okay. Jeffrey Sherman and Jack Ablin, thanks for kicking off the hour with us. With all the major averages finishing the day lower and fading the rally.